There's this specific kind of paranoia that comes with trading.
Mm.
It's not just losing money.
Mm.
It's the timing of losing money.
Mm.
You're watching a chart, say the S&P or gold, whatever. You see a clear breakout. The trend is moving, green candles are stacking. It looks totally unstoppable.
Right.
You finally click buy, and within what, like 3 seconds, the market just stops. Dead. It stalls. And then reverses hard, right against you.
It feels like someone is watching you through the webcam.
It does. It feels personal. Like
Mhm.
there's some guy at a bank desk somewhere, and his only job is to wait for my order to hit the tape so he can dump his entire position.
We know that's not rational, but yeah, it feels that way.
Exactly. So if it's not a conspiracy, what is it? That's what we're going to tear into today. We're doing a deep dive on a framework called market force structure.
And this is a really interesting one because it moves us away from, standard technical analysis. We aren't looking at head and shoulders or cup and handle patterns here. This source material argues that those patterns are just the symptoms. The actual disease, or maybe a better word is the engine, is this combination of physics and behavioral psychology,
Physics and psychology. I mean, those are usually two very different textbooks.
usually. But in the market, they're kind of the same thing. The guide argues that force is actual physical pressure from capital, and structure is just the map of where that pressure breaks.
But there's a catch, right?
There's a catch, and this is what we really need to unpack. Most people think force is just volume. It's not.
Right, because you can have massive volume, just tons of it, and the price,
Yeah,
it doesn't move an inch. We see that all the time.
all the time. Exactly. So the mission for this deep dive is to get you to stop looking at charts as just, I don't know, geometry,
Yeah, shapes.
and start seeing them as a map of collective behavioral pressure. We have this 4-step framework from the guide: force, structure, timing, and psychology.
Okay, let's get under the hood then. Step one is force. In physics, it's mass times acceleration. In the market, what is it?
In this framework, force is defined very specifically as aggressive order flow causing imbalance, and the keyword there is aggressive.
So, market orders. People just smashing the buy now button no matter the price.
Yes, think of it like this. You can have 1,000 people in a room willing to buy a stock at $100. That's a lot of mass, a lot of potential volume. But if they're just standing there with limit orders, passive orders, waiting for the price to come to them, is there any force?
No, they're just the floor. They aren't pushing the ceiling.
Precisely. The market doesn't move because people want to participate. The market moves when participants are forced to act immediately. The guide calls this the why now factor.
The why now? Okay, so that implies urgency.
It implies panic or, at least extreme conviction. A limit order says, I'd like to buy, but only if it's cheap. A market order says, I need this inventory right now and I don't care what I pay for it. That's force. That's what creates the imbalance.
Okay, so we're looking for agency. Where does that usually come from? Is it just excitement?
Rarely. Excitement's too slow. Real force, the kind that creates a massive trend, it usually comes from two places: institutional necessity or, more often than not, the pain trade.
The pain trade. That sounds ominous.
Well, it's the mechanics of liquidation. Think about a short squeeze. If a hedge fund is short and the price rips higher, they aren't buying because they suddenly love the stock.
No, they're buying because they're about to blow up.
Their risk manager is screaming at them to cover before they blow up the fund. That is a forced buy. That is pure, unadulterated force.
Things like margin call, stop losses getting triggered, these aren't choices. They're automated, aggressive orders all hitting the books at once.
Correct. And that creates an inventory imbalance. All of a sudden, you have 5,000 aggressive buy orders and only 500 passive sell orders. Physics takes over. The price has to accelerate upward to find someone willing to sell.
Okay, so force is the engine, the aggressive fuel. Now, looking at the outline of the guide, step 2 is direction, step 3 is timing. But we're going to skip ahead to step 5, the psychology layer. Why the jump? Shouldn't we figure out the direction first?
You'd think so, but you can't really understand the structure, the map, until you understand who's driving the car. The guide argues that the psychology layer is what dictates the physics. Specifically, it dictates friction.
Friction. Okay, sticking with the physics metaphor, how does psychology create friction?
By introducing the cast of characters, the guide breaks a trend down into 3 specific actors. And understanding the sequence of these actors answers your opening question. Why does the market reverse the second you get in?
All right, I'm ready. Introduce me to the cast. Who's up first?
Player A, the early buyers. These are the professionals, the so-called smart money.
Is smart money just a term for people with more money than us, or is their behavior actually, different?
Their behavior is fundamentally different because they're value sensitive. Player A buys when the market is quiet. They buy when the price is low.
Right.
They are the ones initiating the force we were just talking about.
So they light the fuse.
They light the fuse. But here's the key psychological twist that the guide highlights. Player A has no loyalty. As the price moves up and the trend gets going, Player A is not thinking to the moon.
No, they're thinking, I have a profit.
How do I lock it in? Yes.
So they start selling into that strength.
Exactly. And this is the very first source of friction. The engine is still running, but Player A is gently tapping the brakes. They're offering supply to the market by taking their profits.
And I'm guessing this is usually where I show up.
Enter Player B, the late buyer, the FOMO crowd.
Guilty as charged.
Player B sees the trend. They see all those green candles that Player A created. They feel that anxiety of missing out, so they jump in. But, and this is the critical part, Player B is usually entering with market orders because they are chasing the price.
They're adding force.
They are adding a specific kind of force. In physics terms, you could say they're adding mass, but they're losing velocity.
Break that down for me. Mass without velocity.
Think about it. Player A is selling to take profit. Player B is buying because they're chasing. You have a clash. High volume is hitting the market, the mass. But the price isn't accelerating anymore. Why?
Because player A selling is absorbing all of player B's buying.
Exactly. That's the stall I talked about in the intro. You buy, and the market just hovers.
It hovers.
It hovers because you are running into a wall of passive sell orders from player C, the other smart money, who sees you coming. Player C views player B as one thing and one thing only: liquidity.
That's a painful way to be seen. Hello, I am your liquidity.
It's the ecosystem. Players see the smart sellers, they need to unload a massive position. They can't just dump it all at once or they'll crash the price on themselves. They need player B's aggressive buying to sell into. They need your greed so they can exit their position.
So the turning point of a trade, the top of the market, isn't some random spot. It's the exact moment where the early buyer profit taking plus the smart money absorption finally overwhelms the late buyer's buying power.
It's where the force runs out of steam. The inertia shifts. And that leads us directly to step 4, structure. This is where we need to get a bit more granular. How do you actually see this happening on a chart?
Right, because on a standard candlestick chart, it just looks like a long wick or a doji candle. The guide mentions absorption. Paint a picture for us. If I'm looking at, say, the order book, what am I seeing?
Okay, visualize the tape or the order flow. You see a cluster of aggressive buy orders hitting the market. Buy 500, buy 200, buy 1,000. Just green numbers flooding in, high aggression.
So the price